Welcome to the second in our series of tax workshops hosted by the House Ways and Means Committee. Today, we have the pleasure of talking about personal and corporate income taxes with Abby Shepard from Legislative Council and Emily Byrne from the Joint Fiscal Office. Really grateful to members who can attend and anyone who watches in the future forever after. Almost all of the bills that work their way through this chamber have either an immediate or a long-term impact on the revenue of the state. And so we all do our work better when each of us is learning about the work of the Ways and Means Committee. So thank you. And Abby, I'll turn it over to you.
Hi, thank you, Representative. Can everyone hear me okay? Great. So my name is Abby Shepard. I'm with the Office of Legislative Council, and I'm going to start us off this afternoon. And then Emily Byrne from the Joint Fiscal Office will do another presentation on the revenue side. I'm going to walk through the basics of personal and corporate income tax, so two different tax types. And this is building off of the previous presentation that we gave, looking at the anatomy of a tax and how it actually breaks down when you look at tax types like personal and corporate income tax. And also Emily Byrne will be looking at the principles of a tax and how those apply in the personal and corporate income tax types. So moving on, this is the personal income tax presentation. To start off, we'll look at the structure, and then I will talk briefly about what is called the annual link-up. I will look at the definitions that apply to the personal income tax, both federal and state, because our state income tax law is heavily reliant on federal definitions. And I will go through a few recent changes because they were fairly significant last session. So the structure of our personal income tax in Vermont, going back to last week's anatomy of a tax, the tax base in Vermont is taxable income, and that is set out in statute in Title 32, Section 5811, and that's in Subdivision 21. So that's for personal income tax, taxable income. There are progressive brackets and a marginal tax rate structure for Vermont's personal income tax. That's in a separate section of statute. It's 5822 in Title 32. And lastly, the way that the actual tax owed is determined, there are both adjustments and credits to reduce the initial liability. What you actually end up paying is different from just your base times your rate. And that there's a whole subchapter, and there are different parts of Vermont statute that apply to give your ultimate tax liability. Just to give some background as to why in this presentation, I am providing lots of federal definitions. Vermont law does, in many areas, not just in income tax law, does reference other sources of law by incorporating references to other statutes. It could be from another title within the Vermont statutes. It can also be federal law. And in the income tax, both corporate and personal income tax, there is an explicit section that pulls in federal income tax definitions. This works by pinpointing a certain time. So it's sort of like a photograph or a snapshot of federal statutes that were in effect at the end of a given year, because personal income tax operates on taxable year. So it's a December 31st. That's anything that was in effect through December 31st federally, looking at the Federal Internal Revenue Code. And generally, this is updated each year in Vermont. Other states do it differently. There are some states that have this reference to federal income tax code that is not updated every year. Sometimes it can go 5 years, 10 years, and then states make different policy decisions about what federal tax code they want to comply with or incorporate. So this is the actual statute. It's Section 5824 in Title 32. And this first part is what I was just mentioning, the statutes of the United States relating to the federal income tax as in effect on December 31st, 2021, but without regard to federal income tax rates are adopted. So that means that right now, the way this was applied in last year's annual link-up language. There's also an effective date. So it takes all federal code definitions, not tax rates, and applies them to Vermont income tax for the taxable year 21 and going forward. Okay, so moving on from the, and sorry, as we did last week, I think it would work best, especially given that I'm remote today, if we save questions for the end. And that way, because I can't see any individuals here, so I'll let Emily and Sorsha collect questions for the end of my presentation. Thank you. So moving into personal income tax definitions, do you have a definition here for gross income? So we're looking at the biggest category of income. You start with federally defined gross income. It's in the Internal Revenue Code. Gross income is defined as all income from whatever source derived. And there is the sort of seminal tax case from 1955 that states that income is any accession to wealth. Again, this is gross income. This is looking at the broadest sort of category or bucket of income. This is not what is actually being taxed. This is sort of the first level, pulling in all types of income. There are examples included in the Internal Revenue Code section, section 61 in question. That includes wages, tips, salaries, commissions, rent, royalties. There's a long list there. There are also many exclusions. Most of them are sort of peppered throughout the Internal Revenue Code. Those include a certain threshold for Social Security income, interest on state or local bonds, and cancellation of certain student loan debt. That is absolutely not an exhaustive list. So there are lots of different forms of income that are excluded from gross income. That's one way to exempt those types of income from the personal income tax base. And those are decisions made at the federal level, because again, this is your first definition of what is income. Gross income is then carved, sort of minimized or decreased. It's adjusted, and that's called adjusted gross income. That's the next section of the Internal Revenue Code, which means gross income minus certain exclusions and deductions. And a few examples of common federal adjustments are listed here. Teachers' expenses, IRA deductions, student loan interest, tuition, and fees. And these are on the federal form 1041 of the schedule. So you may have seen these on that form. There's a list of many other adjustments here. This, again, is not exhaustive. You do see this come up in other areas of tax law, not just in personal income tax, but this is an example of the types of income that are subtracted from gross income to arrive at adjusted gross income. Finally, we reach the actual tax base. So this is taxable income. This is what will actually be subject to the tax rate. I do distinguish here to make it clear that federal taxable income is different from Vermont taxable income. Federal taxable income is AGI minus itemized or the standard deduction. Also, there are miscellaneous deductions, and those are subject to different rules. So Vermont's personal income tax actually starts with AGI. It does not start with federal taxable income. This beginning, sort of, we call it the starting point for Vermont taxable income, is federal AGI without regard to something called bonus depreciation, which is a deduction allowed at the federal level. And then there are different buckets of income that are either added back or subtracted to reach the number that becomes taxable income. Also wanted to point out that Vermont taxable income is, because it is different from federal taxable income, there are both areas where Vermont has policymaking authority to make decisions about what will and will not be taxed. However, the U.S. Constitution does preempt taxation of certain types of income, and provided two examples here that have come up in recent years. One is railroad retirement income that has been explicitly preempted in federal statute. Additionally, there in statute and case law, there is a prohibition against states treating state source income more favorably than federal source income. So those are ways that policymakers are sort of restricted in how they can tax or exempt. Otherwise, all of those add backs and deductions that you see, a lot of them are policy decisions made in Vermont. So when we look again, just taking a step back in one more visual form, you have federal gross income. These are federal tax definitions minus your above the line deductions equals your adjusted gross income. That's federally. And those all flow through to Vermont. You start with adjusted gross income. Sorry, that one's out of order, but you add certain add backs. So bonus depreciation, which is allowed federally, that's not allowed in Vermont. Interest from non-Vermont state and local bonds, that's also added back. And then you have multiple subtractions from AGI, and that equals your Vermont taxable income. So that is the tax base that the personal income tax rates apply to. There have been several changes to the tax base over the last 20 plus years. Up until 2002, the Vermont tax base for personal income tax was a percentage of federal taxable income. And then in 2002, there was an amendment that made the starting point for Vermont's tax base federal taxable income. It was no longer percentage. And then in 2017, Vermont changed the starting point to AGI, as I've just shown, and that's where you start having the add backs and subtractions. At the end of 2017, there was significant federal reform to personal income tax with the Tax Cuts and Jobs Act. Those reforms generally took effect in tax year 2018. So that session in 2018, Vermont acted to, it had already decoupled to some extent by moving to federal AGI, but there were many other changes that were made in 2018. And in fact, in the 2019 session, there was an additional change made to personal income tax structure in terms of defining Vermont's tax base. So just sort of a list here of what changed. The Federal Tax Cuts and Jobs Act suspended it wasn't a full repeal, it was a multi-year suspension of the personal exemptions. Standard deduction was not suspended, it was in fact doubled. And then there were multiple itemized miscellaneous deductions that were amended significantly. Again, those are all suspended, or that those changes were made for a limited amount of time. Those are in effect through the end of tax year 2025. Vermont's response, because it had just the previous session moved to AGI as the starting point, the changes that Vermont made in response to the Tax Cuts and Jobs Act were to enact, in particular, new definitions relating to personal exemptions and creating standard deductions, and the following year to enact, in particular, a medical expense deduction. Because Vermont had moved to AGI in 2017, that has changed the way that these definitions impact Vermont, so that Vermont has more control over certain changes, and fewer federal changes flow through automatically to Vermont. In last session, there were several significant changes that were made, new tax incentives, and also the sort of annual technical and administrative bill with miscellaneous changes to Vermont's tax laws. That was in Act 179. In Act 138, Vermont did enact, this is the bill that had the bulk of personal income tax incentives. So these are almost exclusively tax expenditures where they're creating credits and deductions, which are considered expenditures because they do reduce some of the revenue that's coming to the state. And I have a short list here, and if anyone has more questions, I'd be happy to provide more detail. But really the high level overview of Act 138 last session is that it created a refundable credit of $1,000. It's a new Vermont child tax credit. There was previously a federal credit. Vermont has now enacted its own for qualifying children, qualifying being based on federal rules and definitions, but only for children age 5 and under. The credit does have a phase out, so the credit amount is reduced when taxpayers have adjusted gross income over $125,000. For those who have under $125,000, it's the full $1,000 credit. The credit is reduced and phases out for taxpayers who have $175,000 of adjusted gross income. And to note that income threshold is both for joint filers and for single filers. The child and dependent care credits that Vermont previously had were consolidated into one credit that is now a refundable credit, and it is equal to 72% of the federal child and dependent care credit. The EITC, which is the Earned Income Tax Credit, Vermont has its own. It's a refundable credit. It was expanded from 36 to 38% of the federal EITC. A new student loan interest deduction was enacted, and that allows for interest paid on student loans, following again the federal definitions of what is a qualifying loan and a qualifying educational institution. That is only available to taxpayers who, if single filers, have an adjusted gross income of $120,000 or less, or for joint filers, $200,000 or less. There is also in 2018, with the response to the Tax Cuts and Jobs Act, in that same session, there was a Social Security benefits exemption that was enacted into law. There are income thresholds to qualify for that exemption. Those thresholds were expanded by $5,000 for all filing statuses. And then several new retirement income exemptions were added into that same section of statute. They are for up to $10,000 of an exemption of retirement income that is specific to federal servants, military retirees, and then other retirees from other states who were not contributing to Social Security because they weren't able to benefit from the Social Security benefits exemption. Okay, so I will pause there. I think it might make sense to take questions about the personal income tax side before I dive into the corporate.
Any questions? Yeah, but it's better for you to, you can stay sitting down and just press the buttons.
It's better for me to use the microphone. So just clarification, when we are getting asked to reduce the taxes on retired military, it looks like we did do that already. Or, I mean, it's maybe not all of it, but right, I can answer with that.
So you are correct that there was action taken to reduce, but it is for only certain military retirees, and not in terms of the income, but in terms of the income threshold. So the same income threshold that applies for Social Security is applied to military retirees. Additionally, there was a further restriction where individuals have to choose one of the exemptions. So it's either the Social Security exemption or it's one of the $10,000 exemptions. So in the case of military retirees, they would need to choose because they can also be eligible for Social Security. So it's both. It has been done, but not to the extent, not fully. It's not a full exemption.
Anyone else? Okay, back to you, Abby. Thank you.
Great, thank you. So I will dive into the corporate income tax, and then we'll be happy to take more questions, and then I will pass it over to Emily Byrne. So we'll look again at the structure of the corporate income tax, similar to the way I just broke down the tax-based tax rate and tax liability for personal income tax. There are some federal definitions that also flow through for corporate income tax purposes from the federal level. And then there were also recent changes in last session that amended Vermont's corporate income tax laws. So the tax base for corporate income tax is different than for personal income tax. So it's Vermont net income, which is also defined in statute. There are also progressive brackets, although there are fewer than for personal income tax. And there are marginal tax rates because each different bracket of income has a different tax rate. And marginal, again, is that last tax rate on the highest dollar earned. There is an addition to the tax rates on Vermont net income. There is also a corporate minimum tax, and that is based on Vermont gross receipts. So it's only those, it's all receipts, but only those earned in Vermont. There are different provisions that apply to calculate tax liability for corporate income tax. There is something called allocation and apportionment, which gets at more complex corporate structures when they have income both earned within Vermont and outside of the state. And I will go through those in the following slides. But first, it's important to point out the way that the corporate income tax applies and who pays the corporate income tax. It only applies to U.S. resident C corporations. So a C corp is a special Very specific business structure. It requires legal incorporation as a separate person, and it's a legal person that is separate from its shareholders. But also what's important to note for Vermont's corporate income tax is it only applies to those that are US incorporated corporations. They're resident corporations in the US. The corporate income tax does not apply to individuals or pass-through businesses, and I will elaborate on that in the following slides. I just really wanted to emphasize it's only C corporations. So what is a C corporation? Yeah, it's an incorporated entity, so it ends in a name like Inc. or Corp, which we've all seen. It is a separate legal person. So I'm emphasizing this because this is really the primary reason that businesses incorporate, is to get this separate status as a legal person that provides it provides protection against personal liability for the shareholders. It's called a C corporation because that is the name of the subchapter within the Federal Internal Revenue Code. Corporate income tax is imposed on the entity, not on the shareholders. Shareholders then do pay personal income tax on the dividends and interests that they receive from the corporation. So it means there are two different income taxes that apply, but what's special or specific to corporate income tax is that there is an entity level tax. One advantage, another reason that businesses would choose to incorporate is to have the ability to raise money on public markets. Whereas pass-through businesses are not able to raise money on public markets. Other individuals and pass-through businesses, again, do not pay the corporate income tax. Example structures are partnerships, LLCs, S corporations, and sole proprietors, among others. S corporation is another subchapter within the Internal Revenue Code. They're for smaller corporations, and there are different rules that apply to those. They S corps and limited liability companies, as you see in the title, the name, limited liability. There are liability protections. That's one of the reasons that groups of individuals typically will form under that business structure. Generally, income tax is not imposed at the entity level for pass-throughs. There are some exceptions, but the general rule is that pass-throughs as entities pass the tax on to their members or their owners or their partners, depending on how they're structured. Also to note, there are rules under federal law that allow LLCs in particular to elect to be treated as C corporations, in which case they would be subject to the corporate income tax. So those are a few of the exceptions to the general rules. In terms of the definitions, we're again going to see the way that Vermont corporate income tax interacts with federal income tax law. Vermont taxes C corporations' net incomes. That's the tax base for those marginal rates, those progressive rates. Net income does start with federal taxable income. And then again, you have the add backs and the subtractions in the same way that you have that for the personal income tax. Examples of what statute does not allow, so what statute adds back because it was deducted federally, is bonus depreciation, non-Vermont bond interest, and federal operating losses. There are additional deductions, so subtractions from federal taxable income in Vermont. Certain income that's added at the federal level relating to foreign credits and job creating credits. And the most recent deduction that was allowed in Vermont is for cannabis establishments after Act 164, because they're not allowed to deduct federally their costs of goods sold. So costs of goods sold. As you'll see in this slide, federal taxable income is calculated by taking a corporation's receipts minus their deductions. And typically for most businesses, there's a cost of goods sold deduction. Wages, other employee compensation expenses, those are allowed to be deducted. Business expenses, interest, non-federal taxes, so state and local taxes, depreciation, and advertising are examples of deductions allowed federally. So that typically flows through to Vermont. And I say typically because there's the exception of for cannabis establishments. Looking at the rates, Vermont's corporate income tax rates are using a progressive bracket structure, and there's a little graph here. There are fewer than we just saw for than there are under personal income tax. The top marginal rate, so what's paid on the last earned dollar, is 8.5%. And again, these are the rates that apply to a tax base of net income. The minimum tax is applied to Vermont gross receipts. So it's all receipts, but only those that are attributable to Vermont. It applies to all active corporations, so those who are registered to do business in the state, those who have a presence in the state, those that in some way have nexus in Vermont. This includes LLCs. I have noted that those that elect to be taxed as a C corporation, so they will be subject to minimum tax. And it's the greater of the minimum tax or the tax under the rate. So if the Vermont gross receipts of a C corporation is 0, then under the rates, they would have a 0 tax liability. So they will pay this minimum tax of $250. And this was amended last session. So this previously had fewer brackets and different minimum tax amounts. Sort of taking a step back, I'm trying to do this in increasing levels of complexity. Moving back towards who is paying and how are they being taxed? What is the income and how do you define that income? Because corporations, there are different types of corporations, different sizes and scales. When multi-state corporations are at issue and considering how to tax more complex structures, because many multi-state or even multinational corporations have complex organizational structures with parent and subsidiary organizations, sort of multi-layered, multi-tiered complex organizations, those entities are often operating in multiple jurisdictions, so not just Vermont. So the rule in Vermont, as it is in most states with the corporate income tax, the simplest situation is when a C corporation's entire income is being earned in Vermont. It's derived entirely from sources within Vermont. In that case, all of that income is allocated to Vermont. However, when a C corporation's income is derived both from inside and outside of Vermont, then you need to apportion it so that only the amount that's attributable to Vermont is being included in the net income tax base. And that formula to determine apportionment is set out in statute. And historically, the apportionment, they're called apportionment factors, had 3 different factors. So they looked at property, where the corporation actually has property, real estate in the state, whether there are employees in the state, and then whether the corporation has sales in the state. And that sales in the state had previously a different definition. It was recently changed to be sales made into the state, where the market for those sales is in Vermont. The recent trend in corporate income tax across the US has been to increase the importance of this sales factor. In many states, that was a move to count that sales factor twice. Vermont, up until January 1st of this year, was a double weighted sales factor state. Other states triple or even quadruple weight the sales factor. And the most recent trend has been to make sales the only factor for apportionment, which is called the single sales factor. And that was one of the changes made in the corporate bill that passed last session. Starting January 1st, Vermont is now a single sales factor state. So that means that when looking at these multi-state, multi-jurisdictional corporations' income, the only factor to determine apportionment of that income will be sales made into Vermont. Okay. So looking at the federal changes that have impacted Vermont, the next few slides are updates on what has happened federally, how has Vermont responded, and then what was Vermont's corporate income tax bill last session, and what did that change? So at the very end of 2017, the Federal Tax Cuts and Jobs Act moved from a modified worldwide system, which meant that not US incorporated corporations, so foreign corporations, would be included in corporate income tax reporting. There was a move back to a territorial system, just looking at US incorporated corporations, and a one-time repatriation, so bringing back foreign profits, and at the same time decreasing the corporate income tax rate. So both a change to the tax base and to the tax rates. starting in 2018, so tax year 2018, the federal corporate tax rate was, the rates were changed. Previously, they were tiered, so it was changed to a flat 21% rate. That was also a drop from the prior top marginal rate of 35%. Additionally, the 20% corporate alternative minimum tax in the Tax Cuts and Jobs Act was repealed. Vermont did not have any response to this, primarily because rates do not flow through to Vermont, as we saw in the previous slides. It's the income definitions, not the rates. However, because of the changes to the tax base with the repatriation of profits, Vermont did have, that did flow through to Vermont. So Vermont piggybacked on that repatriation of profits. And that was a one-time revenue change. And the most recent bill does build off of, and I don't want to say it's necessarily in response to, but does affect some of those same provisions that were changed in the Tax Cuts and Jobs Act. The Federal Inflation Reduction Act, enacted last August, did add back in an alternative minimum tax for corporations, slightly different. It's a book tax. It's a 15% tax that applies to the actual financial statement income, or the income that's shown on corporations' financial statements, but only for those corporations with profits of more than $1 billion. And that started January 1st of this year. There was also a 1% excise tax on the fair market value of corporate stock buybacks. So those are the two major changes in the federal IRA, which do not impact Vermont, again, because Vermont does not conform to federal tax rates. Vermont, again, has its own corporate income tax rates. Last year, Act 148 did make changes to Vermont corporate income tax. And that was actually the bill that had the annual link up to it. So both for personal and corporate income tax. And I haven't covered all of these issues, but I did want to just point out what was changed. I'm saying I haven't covered in this presentation all of these issues because some of these are quite in the weeds. But beginning January 1st, 2023, so these changes have not yet been felt in terms of revenues. Corporations have not started filing based on this new law. That will be seen next year when corporations begin filing in 2024. So as I mentioned, one of the biggest changes in that bill was shifting the apportionment factor for corporations that have income both inside and outside of Vermont, moving from the 3-part apportionment factor formula to single sales factor. So sales is the only factor taken into account for whether income will be included and apportioned to Vermont. Looking at whether the state has jurisdiction over certain entities within a group, a corporate group. That was changed from the Joyce to Finnegan method, which in shorthand means that when there's a complex organizational structure and a combined reporting group, the state will look at the group as one taxpayer instead of looking at each individual corporate member on its own to determine whether Vermont has jurisdiction over that income to tax it. The 80-20 rule. So I did mention that the Tax Cuts and Jobs Act did change some of the rules around looking at foreign corporations. The 80-20 rule was enacted in many states, and Vermont was one of them. That rule has been repealed as of January 1st of this year. That rule would exclude U.S. corporations that were operating primarily abroad. It would exclude their income from the apportionment factors because they were operating 80% of their property and payroll abroad. That rule has been repealed. So those corporations, as long as they're U.S. corporations, even if they're operating primarily abroad, their income will be included in a return for a corporate group. The throwback rule was repealed. That also looked at income that was being earned in other states that wasn't being taxed, either because they were sales to federal to the federal government, which the states cannot tax, they're preempted from taxing, or more commonly, it was because it was the corporation was operating in a way that wasn't taxable because it was just soliciting sales. Even though they were earning income from it, the other state didn't have nexus to be able to tax that income. So this old rule would, what was called, throw back that income into the apportionment factors. That will no longer occur. And then finally, the sort of easiest change to grasp are the changes to the tax bracket. So the minimum tax on C corporations has been amended quite significantly because there are new brackets and new amounts. And that concludes my slideshow. And I'd be happy to take more questions.
Any questions? Okay, with that, Emily, take it away.
Thank you.
Hi, good afternoon, everybody. So I'm going to do, I'm Emily Byrne from the Joint Fiscal Office. I'm going to do sort of a high level, so look at some numbers, look at some fun charts, and then talk about the 6 principles of a high quality tax system and how the corporate and personal income tax kind of fit into that structure. So I'll jump right in. Whoop, supposed to turn it on. There it goes. All right, so just at a high level, just Abby went through this in detail, but as a starting point for the personal income tax, this is the federal income tax form. And this is just sort of to show a snapshot of the things in the big red box on the top are things that are the above the line deductions that Abby referred to. And then box 11 is where adjusted gross income comes in. So that's the starting point for the Vermont personal income tax. And these will look familiar, but then this is the calculation of Vermont personal income tax. So we start with that federal adjusted gross income. We add in bonus depreciation, interest from non-interest, from non-Vermont state and local bonds, and then we subtract things like the standard deduction, the personal exemptions, and then some other subtractions that have been adopted by the legislature to get to Vermont taxable income. From there, to calculate the remaining tax liability, we multiply the Vermont taxable income by the various tax rates based on your family makeup. So either married or single, head of household, et cetera. And that's how you come to your initial tax liability before tax credits come into effect. From there, you take your initial tax liability, you subtract off the non-refundable credits. The biggest one of those is the, no, not non-refundable credits, credits for elderly and disabled, investment tax credit, charitable tax credit, et cetera. Then you subtract your refundable tax credits. The biggest one of those is the earned income tax credit. And we'll talk a little bit more about that in specifics. And starting in 2022, as Abby mentioned, the child tax credit will go into effect. So $1,000 per kid 5 or under. And then multiplied by Vermont apportionment percentage. So that's the idea that not necessarily all of someone's income is earned in Vermont. So you're only taxed on your income earned in Vermont. And you get your final tax liability or refund. In some cases, people actually receive a check based on this calculation from the tax department. Oop. So this is in nominal dollars, an overview of the Vermont tax collections from the personal income tax. It's going back to 2005. You can see during the Great Recession, which are those gray bars, how the Vermont personal income tax took a little bit of a hit. But generally, we've been trending upwards in personal income tax. The other anomaly that you'll note is the bump around COVID. So due to the amount of federal stimulus that was coming through into Vermont income tax system through UI benefits, and just the market was doing well, businesses were doing well, so people had more taxable income. We had a jump during the 21-22 years, but you do see that those dotted lines reflect the forecast that was adopted in July by the Emergency Board. This will get updated on Tuesday when the Emergency Board meets again to adopt a new revenue forecast. You can see that that sort of federal stimulus impact on personal income tax receipts starts to drop back off for the next 2 years. And then if you were to sort of draw a general line from historical income tax receipts kind of through that forecast, we kind of go back to where we were historically. And that all assumes, lots of things about the economy and what's going on. But that's what our projection is. One other thing I will point out from this chart is that back in 2005, the general fund was about 48% of personal income tax receipts. That has went up to close to 60 in 2022. So there is sort of an increasing reliance on personal income tax receipts in the general fund. This is a sort of high level overview of who pays. First, I've got a chart numbers, and then I did a graph of the same information following, because I know some people like tables, other people prefer charts. But this shows the 2020 actual personal income tax returns. If you notice at the top, or all the way to the AGI income bracket column shows sort of how much AGI each group had. Column next to that is the number of returns filed for each of those groups. You'll note that nearly 30% of returns were filed by people with adjusted gross incomes that were negative to $25,000. Then if you kind of move across the table, you'll also see that their amount of taxes paid for that group is a negative number, because in aggregate, that entire group actually received funds from the state. As you can look through the table, you can see that as we go up, the number of people in each of those AGI income brackets decreases till we get to the top, where we have about 2% of taxpayers at over $300,000 of AGI are contributing over a third of the personal income tax. And if you add the bottom two together, the over 150, you're at over 50% of Vermont's personal income tax is paid by about 8% of the population. It's shown again on this chart, the bars reflect the number of taxpayers in each of those AGI income brackets. And then the orange line is the amount of money paid. So you can sort of see that inverse relationship between the number of payers and the amount of taxes paid, and how that flips as you move up the AGI incomes. This is also, I believe I had this slide in my presentation last Friday, but this is a graph of the effective personal income tax rates by federal AGI income bracket, and this shows that progressive slope of the Vermont income tax. The effective tax rate for everybody on average is about 3.67%. One thing I will note of this slide is this is from 2020. Once we have 2022 data and the child tax credit has gone into effect, what we'll actually see is a reduction likely in the effective tax rates, given that tax credit goes up to $150,000 worth of AGI and phases out by $175,000. And the slope of the line will actually sort of go down, and then it will get steeper on the higher income end as a result of that tax credit. For the corporate income tax, another few charts. So just as a reminder, right, who pays? This is on C corporations. This is not, these are larger businesses. Profits accrue to the corporation. They usually have a lot of shareholders and can, like Abby said, can sell on the open market, stock market. And corporate tax is paid on the net income of the C corporation, and that's all outlined in statute. And Abby did a great job overviewing what net income means in this case. Who does not pay? Pass-through entities. So these are folks who sole proprietorships, partnerships, LLCs, whose income, the profits are passed through to the owners of those businesses through their personal income tax. This is a chart similar to the one I showed for the personal income tax, but this is the collections of the corporate income tax since 2005. You can see there's a little bit more bumpiness to collections. Corporate income tax is usually more volatile generally. Part of that is because there's a very small number of payers for a majority of the receipts of the corporate income tax. There are, of the payers of the corporate income tax, about 3/4 of them pay the alternative minimum, which equates to about $2.5 million of receipts. It's projected to go up to about $5 million once the new brackets go into effect that were passed last year in Act 148. The remaining receipts, so if in 2018 we had about $100 million, $2 million was paid of the minimum, 1/4 of the income of the corporate income taxpayers paid about $97 million of the corporate income tax. So it's a much smaller base. Similarly, in 2005, the general fund receipts from the corporate income tax were about 5.8%. That has gone up over time. So more and more corporate income tax is embedded in the general fund. And we sort of see the same trend as we did on the personal income tax related to COVID. We had a big jump in corporate income tax due to sort of what was going on in the business cycle. And then it's projected to kind of go back to normal soon. This is also, I spoke a little bit about, we think about the corporate income tax as being generally more volatile than some other taxes. And this graph is sort of demonstrates that in terms of percent changes year over year, kind of going up and down. And just point out that the scale on the side is in tens of percent. So it's pretty big jumps year over year. So I'll jump into the 6 principles and sort of how it applies to personal income tax and corporate income tax, just in thinking about making changes to these systems, sort of how they work, and what choices have been made by the legislature in terms of policy making and the good principles around a high quality tax system. So again, those 6 principles: sustainability and reliability, fairness, simplicity, economic competitiveness, tax neutrality, and accountability. From a sustainability perspective, the income taxes are known to be more volatile, both the corporate and personal income side. Individuals and businesses are generally impacted by the business cycle and things going on in the economy, which can impact receipts. And greater progressivity in the tax code can mean greater volatility, generally given the amount of income or the amount of personal income tax that we gain from the highest earners. They have a little bit more portability and ability to move their income. So if there's changes in that, you could see a little bit more volatility in the personal income tax. And reliability, Vermont's, it's no secret, Vermont's population is aging, and the working age population is shrinking. Retirees generally have lower income, which means they pay less income tax. And as that demographic shift starts to happen over time, that may impact the personal income tax and the receipts that we're getting. Similarly, to the extent income inequality is increasing or increases, a greater share of tax receipts will come from from a smaller number of high income filers. There's also some reliability challenge in terms of links to the federal tax code, both on the corporate and personal income side. If and when the federal government makes changes to the tax code, that ends up flowing through to Vermont. We have to, change laws to react to that. And similarly, economic cycles can impact both the tax bases. I think I was thinking more about the corporate income tax side on this front, and just what's happening with corporations, both generally in the economy and also specific sectors can be impacted by things going on in the greater economy and impact state receipts. Fairness. So Vermont's income taxes are progressive. They promote vertical equity. People with lower incomes pay a lower percentage than those with lower percentage of their income than those with higher incomes. According to the Institute of, I can't remember what ITEP stands for. Taxes and Economic Policy, I think. The personal income tax is one of the most progressives in the country. And they did an analysis based on 2018 that we were one of the most progressive in the country. Based on the passage of the child tax credit is likely more progressive than it was when that study was done. From a simplicity perspective, right, if you're policymakers thinking about both the personal and income tax code, wanting it to be simple for people to comply with, thinking about what kind of deductions are going to be applied, credits and exemptions complicate it, but it does make the system more fair. So it's balancing those two things in the corporate and personal income tax code. And complexity arises in the personal and corporate income tax world and how we define income, what's counted as income, what's not counted as income, the rate schedule, right? Do we tax certain types of income differently than others? And when we're thinking about the corporate income tax code, simplicity comes into play, and how do we define nexus, and sort of a lot of the complexities that Abby brought up, navigating sort of legal challenges in the corporate world. Economic competitiveness. So the complexity of income taxes generally makes it hard to compare across states. We do want to make sure that the corporate and personal income tax structures that we have don't drive businesses or individuals to make decisions about where they're going to locate and move across borders. It's hard to compare them only because rates and definitions are different in each state. So it's hard to say what those, how we sort of stack up. But in general, on the personal income tax side, Vermont does have a lower effective rate than most of New England, but the effective rate in the state increases sharply when you get to the higher incomes. Ooh. Tax neutrality. There are incentives built into the personal income tax and corporate income tax code. For example, there are credits for capital gains exclusions, investments in research and development. The one I like is the 529 tax credit to incentivize people to invest in college. Similarly, the charitable tax credit deduction, sort of incentivizing people through the tax code to give funds to charity. Those decisions are all in the tax code and inevitably likely drive people to make decisions about their funds as a result of the tax code. And then the last piece is accountability. Keep making a pitch for the Vermont Tax Expenditure Report, which comes out every 2 years. It'll be out on January 17th, which is Tuesday. And aside from the personal exemption and the standard deduction, there are 24 tax expenditures. It costs the state about $7.8 million or $77.8 million in 2020. The biggest one of those is the earned income tax credit. There are 14 corporate tax expenditures. The one that we can report on is the research and development tax credit. Because of suppression issues, there isn't data on a lot of the other credits that we can report on publicly. And of note, Abby brought these up again, but 138 of 2022, we have the new child tax credit, which is going to be a $32 million tax expenditure, which is the biggest tax expenditure that we have. That it's bigger than the EITC, the earned income tax credit that we currently have, and some of the other tax expenditures that were built into that bill, like student loan exemptions, military retirement, the Social Security exemptions were about $8 million worth of tax expenditures. My last slide is just a high level overview of some of those tax expenditures on the personal income tax side. You can see the earned income tax credit in 2022 is about $26 million. Next year, when we have the 2022 tax data, you'll see the child tax credit on here. That was quick, I know, but I know you guys have stuff to do. Yeah, that's what I've got today on personal and corporate taxes. I don't know if anyone has any questions. Great.